Alright, welcome back to another section of the course. In today's video, I'm going to be going over the topic of understanding the objective of price and why that is so important. And I recently decided to put this video into the section 1 of the course, which is like basically the required section, going over my strategy, because I do believe this is extremely important, and I don't want people to be not watching this video because I later put it into the case studies or advanced concepts. So I'm going to put it together within the required section of the course so everyone watches this video. Let's just first though go straight into the 15-minute here. Okay, so the 15-minute here, as you can see from this point on in the course, you guys should know roughly about everything. Let me check real quick. It should be, yeah, you guys should know roughly everything within my training system except for the daily routine checklist, potentially, something like that. But entry and structure, you guys should all understand that by now. So I'm just going to go off what you guys already understand. This here is our 15-minute structure. 15-minute, we are bullish, right? We come back into the origin on 15-minute, and we push higher, and then we come back to the origin on 15-minute again here, and we push higher, make a new high. So the 15-minute externally, the external structure 15-minute is bullish. Now what happened here, right? So the objective of price on the 15-minute is bullish. But remember, the objective of price on every time frame is going to be different. It does not always have to align with each other. So currently at 15-minute, it was very bullish, right? On 15-minute, but let's drop down to the 5-minute here. I want to go over this real quick. So on the 15-minute, you see structure like this, right? We have this pullback to the origin of 15-minute here, and we should be expecting to create another new high if we truly want to continue 15-minute trend, right? But number one thing to write down now is every trend will end at some point. Regardless of what time frame it is, at some point that time frame's trend will end. Price does not continue going up forever without any sort of manipulation or liquidity sweep. Does not continuously go up like this forever. It can maybe make 2 or 3 break structures to the upside, but typically after 2 to 3, the trend will typically stop, and you can expect potentially liquidity to be swept, or we completely reverse the trend. And so there's a lot of manipulation there. But 15-minute, it should look something like this. But for now, 15-minute is here, right? What do we see here? Well, first off, we see on the 1-minute, we're creating external structure on the 1-minute now. Why? Because you can see based on time, over a period of time, like I mentioned in the case studies, which you guys, if you guys haven't seen that, you will see later. But essentially what this means is that over a period of time, as time goes by, price will create new structure and not follow the old structure here. This is old structure here, right? Off the 1-minute swing structure. But you can see price is taking a very long time to come back and retrace back up here. It doesn't always have to retrace all the way back up here. It could be creating its own new structure down here to then slowly come back up here. And so that's exactly what's going on right here. So we always follow what the market is currently doing, as well as learn how to anticipate the market from what it's currently doing. So structure here, internally, basic internal swing structure, right? There's 3 types of structures, guys. Remember, there's external, there's internal, and there's also internal. Now these 2 internals, I haven't fully decided on how I'm going to specifically name them and distinguish them to you guys, but as long as you understand the concept, that's all that matters, and does not really matter. But we can just name it, I gave it many different names before, but let's just name it this for now, for the sake of today's video. There's internal structure, external, and then we'll name for the candle to candle structure that I taught you guys previously, we'll just name this internal fractal structure. You could also name this microstructure, whatever you want to call it, but just know this last one is candle to candle structure. So each and every single candle is a pullback. It's creating its own structure. This is all internal fractal structure here, right? Because on the seconds time frame, all this will look like a swing point. So there's external structure, there's internal structure. which is essentially, remember, internal structure is structure that is created within external structure like this, but it's tradable. What does this look like here to you guys? This looks like a part of a QM model, right? We create new internal structure, part of this external structure. Why is it internal? It's because it's between the swing high and swing low of the external structure, and price within this range has not created a new high or low, and thus it is within this range. It's just ranging here, but trending within that range, right? So this would be tradable internal structure. So that's exactly what the 1 minute is doing right now. The objective of price on the 1 minute here is creating internal structure down to the 15-minute demand, which makes sense, right? That will be your draw on liquidity, which clearly you're expecting price to come back to the 15-minute and then go up. Let's see what happens here. Create internal structure here, and don't mark this high, right? Because this high, the reason why I'm not marking my 1 minute swing structure to this high is because this high didn't do anything. It didn't put in a new low. It just put in a failed breaker structure, which is it held this low. Therefore, this high is now weak temporarily, so it gets ran. Once it gets ran, then we can decide whether we want to continue dumping in this trend or just start reversing from here. Now, the main thing to understand here is that this essentially would be like a liquidity sweep here. Just sweep this high prior to coming down lower. Now, we could have just went up from there, so this is something to be careful of, but I didn't take any trades here, so there will be no difference here. And so you can see that's why I'm marking this point, because this point made a new low. So price was on a 1 minute, internal structure is like this, and then boom, it broke past the high. That made a new low. This high should be strong, and it broke above, therefore now this high is no longer strong. We are changing character to the upside now in terms of internal structure. Now here's the thing. Before, I always mention it, this is extremely important, before you even consider marking a change of character, because change of characters are extremely strong. What a change of character means is the entire market swing structure is shifting to a reversal, right? It's going all the way back up, a huge reversal, right? And reversals are not very high probability, right? Continuations are obviously higher probability. Trading these continuations with the trend when it pulls back. But changing characters are a lot less probability. So the main thing to distinguish between whether it's a real changing character or, like I mentioned, this would be a sweep. It could be a sweep or a changing character, because if it's a sweep, it sweeps the high to take out stop losses just to continue the trend again. And that can most definitely happen, especially if this is inducement here, which in this case it's not, by the way. It's basically not inducement here. It could actually be, could be inducement for this here. I didn't see, but this is way too far in price, right? This point is way too far in price, and we're more focused on what price is currently doing here to try to cash these trades here. And so this could have been inducement here, but the reason why we didn't mark this as inducement, and we actually marked this as what I marked as internal change of character, is because look to the left. You always look to the left and see what price has tapped into on a higher time frame. It could be the higher time frame or lower time frame. Just make sure you refined it so you understand if it's higher or lower time frame. So in this case, it is the 15-minute demand. Origin. Origin is very important to understand. If this was a flip, then potentially it would be a sweep, because it could just come back for the origin. But this is the most extreme point price has to hold if it wants to continue higher, because this is a strong low here on the 15-minute. And so therefore, this is a valid internal change of character, because we have context built that we tapped into a valid high time frame POI. If we didn't, right, if what happened here is happening here, it's not valid. Like here, this is not a valid change of character, right? We tapped into a flip, right? But it's not the origin. There's still something unmitigated down here. Now, definitely this could potentially become a change of character. Price comes back here and then continues higher. It can do that, but it's definitely lower, way lower probability, right? Because we know there's something still missing. So that's essentially what happens here, right? You can see price that's occurring here. Look at this. It's a sweep right there. We came back, made a new low, and we swept this as potentially inducement here. And in here, there's actually nothing really unmitigated aside from auto up here. So this would just be a pure sweep to make a new low. And you can see how that can catch a lot of people off guard. So the main thing, like I mentioned, make sure you understand this, is to always look at the higher time frame and look to the left and to see where price has tapped into. If it's a valid demand, like this 15-minute origin, then it's more likely to be a changing character than a sweep. Price is likely to shift trends now. So that's what happened here. Price has now shifted to the upside. So what can we see here? We see an inducement here. Now, obviously, if you're on the 1 minute, you would think this is not inducement here because it did tap into the 1 minute origin. Or did it? Actually, it might not have here. Let's see. Nope, it actually did not tap into the 1 minute origin here. So never mind. But I did see later, this is on the seconds. I didn't take any trade here, but if you did go to the 30 seconds, there was a 30-second origin there, but we can remove that. I actually missed the 1 minute origin here. So this is inducement here because it made a new high, but never came back to the origin. So this origin then got tapped into, and we made the new real break structure. So you could have took an entry here, right? You could have took an inverse fair value gap, could have took any entry here, either this SCOB entry model right here, which is perfect. And you guys can just see how we can put the puzzle pieces together and start catching really good trades. 3R right here, and this is a pretty fast trade, I would say. For sure, you can even target up here if you like to the higher time frame POI, right? And in this case, we got swept, and I'll explain that sweep in a bit. But essentially, this sweep, remember the objective price right now is bullish, right? This internal structure is now bullish. So what's happening here is this. This is what's going on internally. But you can see now, this is a perfect example of what I mean by internal structure versus external. External is looking like the black. Internal is looking like the blue. This internal is a structure within this external swing structure. That's all it is. It's this tradable structure that's giving us opportunities trading alongside or against the external structure. That's all it is. So what happened here? Well, here we actually had a sweep. Liquidity sweep. Again, me personally, body and candle closures, it doesn't matter as much to me. I do have a video on it, and it does matter to an extent, just as confirmation. But for me personally, your draw on liquidity and understanding structure and where you anticipate price to go is more important, or a lot more important than a simple body closure, wick closure like this. But this is for those that are beginners that want something to be more mechanically defined. But the problem with this, I would say, is because a body closure and wick closure will look completely different on the 1 minute, 5 minute, 2 minute, 3 minute, 4 minute. So that is something that will vary, and that's why I prefer to just look at whether or not price ran high or low, and I'll count that. It's just like here, break structure, I count that, right? Even though it's a wick. So this is a sweep here. Why? Why is this not a change in character? This should be a change in character, right? Because this is the last low that made the high. This should be a strong low. It got taken out, so we should be going down, right? No. Why? Look to the left. We've tapped into here, right? But this is not a valid area to me. We have a lot more better pricing above, and if you do a 50% tool here, we're not even at premium of the range of this structure here. So until price comes towards the premium area and start tapping into these POIs on a higher time frame, or any POIs here above, I'm still looking to buy. This is more likely manipulation, and you can clearly see what happened here. Quickly manipulated and came back to the upside. So this is how you should be viewing price each and every single day. And this doesn't take too much effort to understand, really, once you get the hang of it live. Now, this is where I made a mistake on my trading today. I was expecting another break structure here to follow this trend, but we ultimately failed. And that's why I took a break even here. A very strong break even, because it did run 3R and then just hit out break even. But later I adapted and got a 2R trade, And that's another thing I want to talk about in today's video, which is adaptability. Now, why was I thinking about a break structure here? Well, it's pretty common, right? Because we continue higher. And now here's the thing. Let me change this back to a sweep. The thing here is that this was a bit suspicious to me. This here, I was thinking at the time as just a sweep, liquidity sweep, because I believed the draw is still higher in that we haven't tapped into this flip here or this origin above here. So I was expecting the draw to be higher, and that's why my TP was all the way up here. However, this was actually a change in character. And the reason why is because the 30-minute. And this is why you need to be flipping through your time frames all the time. Now, the thing about higher time frame and why my daily routine video you'll see later if you haven't seen it yet, why I start the day marking my high time frame, and you typically don't see me marking my higher time frame like later throughout the day. And it's obviously because of how time works. If you know how time works, how PY forms, it requires 3 candles, right? So a 30-minute PY takes at least 1.5 hours to form. That's not even talk about 4 hour, right? A 4-hour PY takes even longer to form. Way longer. It takes 12 hours to form. So since those PYs take so long to form, it's very rare for a new high time frame PY to form during your trading session, because most of your trading sessions are 3 hours long. The kill zones, they're 3 hours long. So at most you see a 1 hour PY form, but by then you won't even be taking trades or even using it anyway. So even a 30-minute is a stretch because it's half your session, right? 1.5 hours. 15-minute potential possibility, because that is about 45 minutes, 15 times 3. And that is about almost a third of your training session where it could form. And that's why I do like the 15-minute. I like to use the 15-minute, 1 minute, and 5 minute mainly. Those are the main time frames, but you always need to keep in mind of the higher time frame. And on the higher time frame, I failed to notice this 30-minute supply right here. Now, the reason why I was still thinking higher was because if I was refining this, I still see a 5-minute unmitigated here. Like this 30-minute PY is too big for me, right? It's way too big. So refining it, I would still expect price to go higher, but price doesn't always do what you want it to do, and that's why we need to adapt, right? Typically, it would go higher, but price had a different objective here in terms of delivery, and we just have to be okay in accepting the randomness of outcomes in the market, right? It's a probabilities game. The probability here was very high that price would come back higher to mitigate something on a lower time frame, but it respected the 30-minute, and therefore, you could have had a very nice 30-minute short here for sure, but I was not on the chart at this time, and you can see it would have been a very, very nice trade right here, right? 10R, but unfortunately it was not there. I was here for this A+ setup that I would consider, but writing that down in my journal, obviously this is a change in character here because we tapped into a valid supply zone. So now you guys should understand the difference between this as a sweep and this as a change in character, and I'm also learning that from this as well. Now what happened here, we had a 5-minute, so 5-minute POI, remember cycle through your time frames while you're trading. Internal change in character here to the upside because we failed to put in a new low after making a change in character. We should be making a break structure here, but we did a failed break structure here. And some people would say, how is this a failed break structure if we haven't tapped into the origin yet? This is just a failed break structure for this leg here. That's all it means. It's just a failed break for this leg, meaning this high is temporarily weak. Like I mentioned, temporarily we should be running this to create new internal structure, and then we later tap into the origin where it's our last resort essentially of price to create this real break structure, and that's what I did. So you can see how internal structure is playing out here in this case, where we essentially are creating this internal structure. And what does this look like? This is a QM model. If you guys remember what a QM model looks like, huge move to one side, and then we create internal structure of slow delivery back up but not in one leg, but rather several legs of internal structure that we can trade pro trend with to the origin or whatever is left there, to then take the pro trend of the QM model, which is bearish. You can see that's what happened here. And this just shows how you can really master anticipation of market, but there's sometimes things like this just happen and there's nothing much you can do there. But majority of times you should be able to predict the market pretty accurately, especially with the entry models I've given you guys. You should definitely have around at least a 50% win rate. At least 50% win rate. If you don't, then you just need more experience in screen time and just marking up your structure and learning how to anticipate price in real time as well. But other than that, I mean, that's really about it. So you can see, later took a 5-minute POI, got tapped into here. I was waiting for price to come back to then give me an entry model here. Could have took an OB entry here, but look how high this OB is here. You would have had this would have been a very big stop loss here. And I'm not a 1.7 RR kind of guy, so I don't put my stop loss typically at the buy to sell or sell to buy. You want to put it at structure, so skip that. But later I realized there's a 5-minute POI. 5-minute POI right here. See, we had a gap, 5-minute POI, and therefore took a trade there. And what's my confirmation? Well, you had impulse model here, right? So you could have had an impulse model entry here, or inverse fair value gap. And impulse model, because all these candles are in one direction with huge imbalances, right? That's not imbalance there. I meant this imbalance right here. Obviously, this is a very small range, right? Enough to trade the impulse model, not a huge range like something like this, right? Typically, impulse model occurs with a small range because price delivers extremely fast. So that's what happens. And I basically targeted the weak high plus the origin here. If you find the origin, it would have been a 3R roughly, but I was satisfied with getting 2R here after what happened here. So we later tapped into origin, and you could have had an OB entry here if you wanted to, and you would have had a nice 7R short to target the real break structure here, right? Since we held the origin. And now the puzzle piece is forming now. You guys can see this is what structure is looking like now. Now keep in mind, here's the thing. Every time frame has its own objective, right? So on the 15-minute, its objective was the high, but temporarily it changed due to 1-minute structure creating its own objective. And after the 1-minute structure creates its own objective, it came back, and you can see there's unmitigated POIs here on the 1-minute that were never touched on the 15-minute. Let me delete that. There's unmitigated POIs that were never touched on the 15-minute. You can see even with my indicator, you can see they're unmitigated, right? And so that's what happened here. So because there's unmitigated POIs there, price is finally fully mitigated that, or not everything here, but at least it's mitigated something on the 1-minute here. And we can now expect price to either create a new high here, or we come back to this supply here and potentially drop here. And then depending on how we hold here, if you hold this, get confirmation, we can target the new high. If not, we're likely to want to trade a continuation of this new 15-minute downtrend. So this is where price does get a lot more complicated just due to the different objectives of each time frame. But that's why we use confirmations and we trade off just known probabilities, right? We're not going to expect the market to be perfect, and we're not going to be perfect. Actually, the market is never going to be perfect, but market is always right. So you only blame yourself really for the things that occur. Now, if it's a valid loss, it's a valid loss. But if it's a random trade or a gamble trade or emotional trade, things like that, those are losses on you, and those are mistakes you made yourself. So just keep that in mind next time you trade. Essentially, this is what's going on here in terms of price. You guys should be able to understand now the objectives of price and how internal structure is created within external structure, which you saw earlier I showed on the 15-minute, and how basically price is delivering Here's also an example of QM model here in real time. QM models happen actually a lot, especially when we have a very big move like this. We almost never always come back so fast, right? Like here, this definitely looks like an impulsive model form, impulse model delivery, but it doesn't always have to deliver as an impulse model, right? If you took an impulse model entry here, what, 2R, not too bad, but that's a pretty big stop loss to me. So it would have been up to you whether or not you would want to take the trade. Typically for me, I'd aim for 3RR, but in this case, this is a rare situation here and only got 2R, but typically at least 3R is for me, 3 to 4R average. But that's basically it for this video, basically summing up the objectives of price. Hopefully you guys did learn something, really take away something from this video, because I do believe understanding that each time frame has its own different trend and that all these trends at some point will stop. You cannot expect a strong high, a strong low to hold forever, right? Price at some point will tap into something on the higher time frame, like the 30 minute in this case, or just tap into a model formation, which is right here is a QM model. It will tap into its objective and it will reverse. Like I said, usually there's 2 to 3 times where you will have a strong low, strong high hold, and that's 1 time, 2 times, boom. 2 to 3 times typically, and that's when the trend typically ends. 1, 2, 3, typically ends. I rarely see a strong low hold 4 times, and if it does, typically it gets swept, and then you make a new high. So those are just things to definitely consider in the back of your mind next time you're trading, making sure you're not trading too far up in a leg. For example, you don't want to be trading after price has, you don't want to be longing something like here, for example, and obviously you're taking out, there's no confirmation here, so that's why we trade off confirmations. There's no trade here anyway, but let's say they did have confirmations, because it is possible for trades to give you false signals in the market, because that's how liquidity is also formed, and therefore you would take a loss here. But that's why you need to be careful and understand how far up in the leg you are. This is very far up in the leg because we have already reached premium above 50%. We already reached premium pricing. Therefore, we want to be looking for shorts actually instead of longs, unless we are expecting price to be bearish or bullish through this whole time, meaning take out this high, then we don't really want to be shorting. But in this case, you can see price decided to finally reverse its direction, and that's what happened in basically this price action here that you see today. So those are just key things you have to consider. Again, next time you're trading, don't continuously try to trade with the trend. You know, trends always end at some point, but you want to be catching pieces of the trend, like taking trades here, taking trades here, things like that. And then of course, if you really are a reversal kind of guy, you can also take those reversals as well. And as long as you understand that there is confirmation prior to taking those swing reversals, like this confirmation here of a change of character, 30-minute supply holding, and an origin confirmation here, then that's a very high probability reversal. Otherwise, you typically want to be trading with the trend, right, until it ends. So that's basically it for today's video. You guys learned in this video essentially what price objectives are and how price always has an objective on every time frame, and that you need to understand where that price is going to, where the next price's objective is. And you also need to understand also a backup plan and learning how to adapt to the market, right? For example, when I took a break even here, I took a break even around right here. At this point, I was still potentially thinking about a re-entry, right? You could potentially think about re-entries. Me personally, not a big fan of a re-entry after such a big short move here, such a big reaction off this flip here. This is not even a high quality flip either, because looking to the left, there's not much that really flipped. The demand is more like down here. So it's not even a high quality flip because there's way better PY above here. But as soon as I see this high get taken out, an internal changing character, I'm expecting us to create internal structure to go to the origin. So again, just being able to adapt to market conditions and understanding new objectives of price is also very important. That's going to be it. I'm going to end this video here. If you guys have any questions, let me know.